Should you wait until the stock market crashes before investing? Would that actually be better? After all, you'd be buying low, that's great to do. However, if we look back through history, would it have actually worked? That's what we're going to be talking about today. Today, we're going to be discussing whether or not you should be waiting for the stock market to crash before investing. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. So, here's what we're going to do to answer the title question. We're going to use the S&P 500 to determine whether or not the stock market has crashed, and if at any point the S&P 500 has fallen more than 20% below its all-time high, we will consider a crash to have occurred, and we'll invest whatever money we've saved up until that point. If the crash persists in the following month, meaning for back-to-back months the price of the S&P 500 is still at least 20% below its all-time high, then we will continue to invest whatever money we come up with during that second month. This process will continue until the S&P 500 has recovered enough so that its prices are no longer 20% below their all-time highs. During the months where the stock market is not more than 20% below its all-time high, we will be keeping our money on the sidelines awaiting our next opportunity to buy low. We're going to compare this to someone who just regularly invests their money every single month, regardless of market conditions. In theory, the benefits to regularly investing is getting more shares early on. This can be beneficial due to the dividends you may receive on those shares from time to time. You can then reinvest those dividends to buy even more shares and begin your own investing snowball. That's the theory anyway, but it'll be interesting to see how it works in practice. In both scenarios, we're going to be investing, or saving, $100 a month. A quarterly dividend will be given out, and it will have an effective yield of 2% per year. We're going to be using the average ending net worth of each person to determine if waiting for a crash to invest is actually advantageous. The ending net worths will be measured at every available 10, 20, 30, and 40-year time period, starting from 1928 and going all the way to the end of 2018. With that out of the way, let's find our answer. Is it really better to wait for a crash to invest? In 1928, the S&P 500 was worth $17.66 a share. Little did we know at the time that the worst stock market collapse in the history of America was just around the corner. John is doing pretty well for himself, and he has $100 per month left over after expenses to invest. However, he's also very smart. He realizes that it's often better to buy your investments at a bargain price so that you can later sell them at a premium. He wonders if this line of thinking works the same in the stock market. Therefore, he decides to make an experiment. Instead of investing his $100 a month into the stock market, he will save it in a money market fund. In that fund, it will be earning 2% interest. And this is mainly in the interests of keeping things consistent with the dividends that he would have been getting if he were to invest from the beginning. John will wait until the stock market crashes before moving all of those savings into his investments. He decides that he will not invest any of his money until the stock market is at least 20% below its all-time high. In January 1928, the S&P 500 fell by 9 cents a share to $17.57. By the end of 1928, the price had risen to what was then an all-time high of $24.35 a share, and it would continue to rise all the way up to $31.71 a share in August 1929, and that's when the bottom fell out of the market. In September, the S&P 500 was valued at $30.16 a share. 1 month later, it was down to $24.15. That's roughly a 24% drop from its all-time high, and John is now able to move his savings into investments. It's been 22 months since John began saving for this moment, and thanks to his diligence and the interest he's gained over that time, he has $2,235 available to move into the stock market. At about $24 a share, this will buy him almost 93 shares. In November 1929, 1 month after John made his major purchase, stocks still weren't doing well. In fact, the S&P 500 had fell even further to $20.92 a share. Since this is approximately 34% below the $31.71 all-time high, John will continue to invest. So he puts his entire monthly savings of $100 into the S&P 500 until it has recovered enough that it's no longer at least 20% below that all-time high. In this particular case, that means John will continue investing $100 a month into the S&P 500 until July 1952, because in July 1952 the S&P 500 had recovered to $25.40 a share, which is barely enough for John to stop investing. At this point, John has 2,990 shares in the S&P 500. His total net worth is just under $76,000. He's invested $29,400 of his own money over the course of this example, and has an effective rate of return of about 6.8% per year, which doesn't sound great, but keep in mind that's 6.8% per year during the hands-down worst stock market crash in American history. To me, this is a great lesson in the power of investing. However, that's not the video we're here for today. Today we're trying to figure out if waiting to invest until the market crashes is better than just investing regularly. So I pulled up Excel and ran John's experiment to see what his ending net worth would have been in all of the available 10, 20, 30, and 40-year time spans between 1928 and 2018. On average, under the assumptions we just talked about, John's ending net worth at the end of every available 10-year time span is about $17,000. At the end of all 20-year time spans, it's about $62,000. For 30-year time spans, he ends up netting around $181,000. And finally, his average ending net worth of all available 40-year time spans is about $443,000. However, if John had just invested his $100 a month from the beginning, instead of waiting for the market to crash, he would have actually fared better. His average ending net worth for all 10, 20, 30, and 40-year time spans were $20,000, $73,750, $206,000, and $489,000 respectively. We see a similar pattern play out when looking at the median, minimum, and maximum net worths of each scenario. If John had waited for the stock market to crash before investing, his median ending net worth would be $16,900 for all 10-year scenarios. It would have been $54,650 for all 20-year scenarios. He would have amassed $176,000 in the 30-year scenarios, and $415,600 in the 40-year scenarios. Had John invested consistently from start to finish, he would have improved his fortune by anywhere from nearly 10% to almost 30%. His ending median net worths for all those scenarios would be $19,400 for the 10-year, $70,500 for the 20-year, $190,400 for the 30-year, and over $450,000 for the 40-year. John's minimum net worth for each time span was $8,900 for the 10-year scenarios, $19,200 for the 20-year scenarios, $65,900 for the 30-year scenarios, and at worst, nearly $215,000 for the 40-year scenarios if he had waited for the market to crash to invest. If he had just invested consistently from start to finish, his worst-case net worth for each time span would be $8,300, $29,000, $87,100, and $235,700 for the 10, 20, 30, and 40-year scenarios. John's maximum ending net worth for each time span was $27,000 for 10-year scenarios, $134,300 for 20-year scenarios, $453,500 for 30-year scenarios, and $947,400 for 40-year scenarios, assuming he waited for the market to crash to invest. If he'd invested consistently, his best case net worth for each time span would be $37,600 for 10-year scenarios, $177,500 for all 20-year scenarios, $487,500 for the 30-year scenarios, and finally $961,600 for all 40-year scenarios. You'll notice we do see the waiting to crash strategy beating out the consistent investing strategy in John's worst ever 10-year stretch. However, outside of that one instance, this contest was very one-sided. I guess that's where the old saying comes from, though. Time in the market beats timing the market. But how can that be? Buying low is supposed to be a good thing, right? Shouldn't you end up with more money if you're only buying when the market is low? Especially considering in this particular example, the dividend that John was getting when he was investing in the market, and the interest that he was getting when he wasn't investing, was 2%. So shouldn't John's income have been the same either way? And the answer is, sort of, but not really, because they're calculated a little differently. Let me explain. If you have an effective dividend yield of 2%, as we did in John's example, that means that the dividend per share is going to be 2% of the share price per year. However, since this stock, like most stocks, pays out dividends once a quarter instead of once a year, that 2% would be split into 4 separate dividend payments. This makes a pretty big difference over time. Here's an example to show you how. In March 1928, when the first dividend John received was declared, the price of the S&P 500 was $19.28. Since the total yield for the year was supposed to be 2%, this first quarterly payment, assuming they're split equally, should be about 0.5% of whatever the share price happens to be in March of 1928. 0.5% of $19.28 is approximately 9.64 cents. At that time, assuming John had been investing $100 a month consistently, he would have owned roughly 16.67 shares because of the price fluctuations between January and March. 16.67 shares times 9.64 cents per share is about $1.61 in income for that quarter. On average, that would come out to about 54 cents per month, just because of how the share prices and the dividends interact with each other. However, interest on things like savings accounts is just based on how much money you have in that account. For every $100 John has in his savings account, he earns $2 per year in interest. If John saved $100 on the first day of each month, he would earn about 17 cents in interest in January, 33 cents in interest in February, and about 50 cents in March. On average, that comes out to be about 33 cents per month in interest, which is quite a bit lower than what John was getting based on dividends. So you can imagine how this small difference between the two methods would grow over time, especially when we're looking at like 40-year time spans. But what do you think? Is waiting to invest worth it? Let me know in the comments section below, and let's get this discussion going. Also, if you want to learn more about investing during a crash, you can check out the links to the videos on your screen. One of the videos goes over the history of stock market crashes throughout the years. The other goes over what to do during a stock market crash. Lastly, if you haven't already, be sure to like the video. Like I said, it really helps the channel out a lot, and thanks for watching.